All right, so that's the RBI governor press conference and the last question on Panama Papers. But a fair bit of focus on interest rates and liquidity, essentially two areas, more so on liquidity more than the rate of interest being reduced itself. And the governor very confident there, saying that it's not just the rate, it's not just 25 basis points, but everything together, I mean, which will make a difference, which will bring down borrowing cost in the economy lower, which will it'll help to do that. You know, before I think Atul got a word in earlier. Madan, I was asking you for your assessment. Now you have the governor's statements as well. Why don't you tell us what you make of the policy?
So actually, I would go more on the talk something on the macroeconomics of it. I think if the RBI is also saying that growth is going to be around 7.6%, inflation at 5%, it's actually an indication that we may not really be expecting too many rate cuts further during the year. Because again, going back to his 1.5% to 2% corridor of real interest rates. So I think if you're talking in terms of a base of 5% inflation, and today I'm at 6.5%, I really have very little elbow room to lower rates further. The second thing is on terms of GDP growth or value added, which you're talking of 7.6%, it's not going to be very different from what it was in fiscal 16, which actually begs the question that despite the fact that the government appears to have put lots of policies in place, we have a budget which is supposed to be pro-growth, interest rates coming down. But overall, I think the expectation of both the government of India, based on the economic survey as well as the Reserve Bank, is that things are not really going to change dramatically at the ground level. And we're going to remain at a more or less status quo position. And just one point based on what was there in the policy and also which was discussed was the impact of the pay commission on inflation. There I would not really agree with what the Reserve Bank is saying in terms of adding to 1.5%, up to 1.5% inflation. Because today, given the fact that we have surplus capacity in industry, in case there is additional spending which comes from government officials, I think it will definitely help to improve the capacity utilization rates rather than add to demand pull forces which could be inflationary.
Okay, fair enough. I have Anshula Kant who joins me right now. She's a Chief Financial Officer with State Bank of India. Ma'am, thank you very much for your time. Good afternoon. Prashant here. Can you hear me, ma'am? If you can, what's your take on the policy? Especially on liquidity, ma'am. What's your take? Yes.
Actually, we were expecting some good news on this front, and I think we have got as much as we expected or more. So we are happy with the conversation on liquidity and the accommodative stand which the governor has taken. Because this was, despite the fact that RBI had cut rates, by a fair bit, 150 basis points now, the transmission could not happen because liquidity was tight. I think the banking system was in a significantly borrowing mode, and that also raises our cost of funds. So we are really very happy. They have talked about, infusing core liquidity. They have spoken about, infusing at least 80 to 90,000 crores. And as the stance moves gradually from deficit to neutral mode, I think it will be very good for the treasuries of the banks. Some rate cut had already been priced into the bond yields, but I think going forward with easing liquidity, bond yields should further come off. We are happy with this actually.
Ma'am, the graphic on I don't know if you have a TV there, but essentially this is a comparison of repo rate versus the base rate for banks. I mean, take a look at this graphic. It will tell you what has happened. So April 2014 till date, repo has come down 1.5%, including today's cut.
I really can't see the screen,
The base rate is down about 0.6%. You were saying that a large reason why full transmission or even close to full transmission hasn't happened is because of tight liquidity. That has changed now. We've got other periods as well, on your screen now. So should we expect a cut now, ma'am, from State Bank in your base rate?
Yeah, I can't, Prashant, I can't see your screen, but I'm not in a position to see your screen. But what I will share, we have cut our base rate by 70 basis points in up to December 31st itself. And since this MCLR regime has kicked in, actually our base rate used to be 9.30. It is still at 9.30. Our overnight MCLR is 35 basis point lower at 8.95. So if you compare from where we've moved, 70 plus 35 is actually 105 basis points. What the transmission will ease to the extent, there is a structural issue here. Now in the current regime of MCLR, entire spectrum of funding, including your current account,
just one
savings
point.
bank
How is it
deposits,
105
fixed
basis
deposits, and your
points?
borrowing in the market.
How is it 105 basis points? You said 70 is the base rate card.
We cut.
What is the rest?
Okay. I'll share with you. 15, 15 and 30. This was the base rate cut which we did over the last, up to December itself. And if you see, our base rate was 9.30, which had a 70 basis point cut behind it. And the MCLR that we announced from 1st April, the overnight MCLR is at 8.95.
Right.
Hello?
Yes. And the 1 year?
Hello, have I lost you?
And the 1 year? I'm here, ma'am.
The 1 year is at 9.20. The 1 year, so 1 year is at 9.20. That has also declined by 10 basis points.
9.3, which is the base rate, right?
it
Only
will
a 10
come
basis
down,
point
cut by
difference.
80 basis points. If you take the... That's right. With the 1 year, with the overnight, it's a 35 basis points difference.
Yes.
And
No, but
prior
we
to
should
that,
look
the
at-
base rate itself, we had cut by 70 basis points.
Right. So total is 80 basis points, right?
Hello.
I mean, if you
So
include
can I
the...
just, what I'll just like to...
No, so ma'am, we can talk about the
No,
past,
no.
but what is
See,
likely to happen in the future, ma'am? Are we likely to see more cuts? Not from SBI. I'm sure you have to go back, talk to your team and what can be done. But should we expect borrowing rates to come down?
Absolutely. Borrowing rates will come down, and like I was mentioning, about 42% of our deposits are CASA deposits. So the rate transmission now in the current MCLR regime can happen through the remaining, 58% deposits, which is the fixed deposits. So as we reduce our rates on fixed deposits, the transmission will happen through the MCLR, but only to the extent of 58%. So that is one limiting factor that we have. The trajectory will be downwards, that much I can assure you from our bank also. Obviously, the interest rate trajectory will be downwards, but we will need to cut deposit rates, without which we cannot cut MCLR. And our also other compulsion is that our deposit rates are actually significantly below the market rates already. And we will see how the competition reacts towards the deposit interest rates, and the fact that liquidity will ease to that extent, our ability to cut deposit rates has also gone up. So to that extent, we again welcome this policy and the easing of the core liquidity that has been talked about.
Right, ma'am, can you talk in numbers for SBI, this minimum daily maintenance of CRR going from 95 to 90%, what would it mean?
So for SBI, it would be about 3 to 4,000 crores, I would say. I think for the system, it would mean about 23,000 crores or so. This is rough ballpark numbers, back of the envelope.
Okay. Do you? There is a OMO which has been announced as well. But overall, on liquidity, and I think there was a fair bit of focus there, and the governor took some questions as well. Do you think enough has been done to address that? Or you think more needs to be done? A CRR cut was needed?
I think, given that we are in the first half of the financial year, it's a good beginning. Because typically credit growth is slower in the, first couple of quarters, particularly the first quarter. And if, the government balances come down, coupled with this neutral stance on liquidity, which should, give us about 80 to 90,000 crores, lower borrowings, I think we should be comfortable now. And the fact is that, the corridor, interest rate corridor has been reduced also to 1%. That will also keep the interest, our borrowing, if we do have to borrow under the MSF, it will keep it range bound. Till yesterday we were, every morning the call rate would open at least 80 to 90 basis points higher than the repo, and that also will get limited by this 50 basis, the narrowing of the corridor. So I think all in all it's a very good
be closer to the repo
stance. I think
now it would be closer to the repo in a narrower range. Is that what you're saying?
Exactly. Yes.
And that would allow you to...
Yes, it would be closer to the repo,
Yeah.
and if it goes above the repo, then plan your liquidity better. And I think I was listening to the governor. He says now the banks will have to pay less for their mistakes. Meaning, if you do have a liquidity goof up and on some day and you have to go to the market, and it's not a goof up, but you do have to go to the market off and on to manage your liquidity. To that extent, our cost of borrowing will come down.
Okay, fair enough. Is it possible for you to tell me if in the immediate, put a timeline to it, when you are the leader, you move on rates first, the rest of the industry usually follows. Should we expect any changes from SBI in the near future, or we'll have to wait for some time?
In any case, Prashant, now there is a defined date and time when you announce the MCLR rates. So our next announcement will be now effective only from 1st of May for the MCLR. So we will now take an assessment of how the liquidity will look, where our deposit rates are, and how the competitors have moved. The competition has not followed us on the deposit rate cuts, barring very recent cuts in the last 2-3 days of March. So we'll take a call on that, and I think the trajectory, of course, is clearly downwards. Transmission will certainly be easier now. I think we'll get more flexibility to move towards a lower interest rate regime. And
anything else in the policy?
Of course, given that this easing of liquidity.
Sorry,
what we are
point.
happy also about this, easing of. Yeah, easing of liquidity is that, although some of the rate cut was priced into the bond yields, but we do expect that bond yields will come off further. And, the upside that we may get in the treasury side now looks much more optimistic. That will give us more room and cushion to cut rates and, take care of other costs that are there in the system now, currently.
So, the quarter is, the books are closed, the quarter is closed. Could you give us some ballpark numbers, ma'am? What would the gains look like there?
No, for the quarter, I completely cannot talk about the previous quarter, that is March. And but the fact is, already I think in the last 3-4 days, the yields have come off significantly for the last 10 days or so. But we may expect it to go down further to about 7.25 or so, the 10-year.
Okay. Since I don't know if you want to answer this, but very broadly, would the kind of asset quality impairment and numbers that we saw in the third quarter, October to December, will Jan to March also show those kind of numbers? Bigger, smaller, at the same level, ma'am? So any idea at all?
I of course have a very fair idea, but I am really not able to communicate on the fourth quarter, except to repeat what we clearly mentioned when we were announcing our December results, that we had taken about 50% of the AQR in December. A similar number would be expected in the next quarter. This is what we had communicated when we declared our December results. I think beyond that, for me, it would not be appropriate to talk about the March quarter now.
Okay, fair enough. Ma'am, thank you for your time. Appreciate you joining us, and good luck, and look forward to more, to lower cost, lending rates, borrowing cost, coming off steadily. Thank you indeed. So that is the State Bank of India's CFO with that perspective coming in. I think markets are off, and stock markets are now firmly settling down. Settling down. 110 points lower on the Nifty, 370 odd points lower on the Sensex at this point as well. Mr. Srivastav is still with us. Atul, Madan, Mr. Chaudhary, Mr. Srivastav, everybody is still with us. Thank you for being patient. Mr. Srivastav, I didn't get a chance to ask you for your thoughts. As far as the policy goes, and you heard the conversation with the SBI CFO as well. What's your perspective, sir?
Okay, we think that it is on the expected lines, a little bit of surprise in terms of narrowing down the corridor. I mean, I think this has primarily been done to give the access to liquidity. Anyways, if you look at the term lending repos, reverse repo, they were coming at more to the repo rates. So RBI was not discriminating between the repo rate and the reverse repo rate. The cutoffs were closer to the repo rates. And now the major thing has been the MSF rate has been brought down by 75 basis point. Being a 50 basis point corridor, I mean, more people could look to access, more banks could look to access MSF because the cost has come down. And if you look at the MCLR, it is just set in. And I think from the rates, if you look at it, although the governor has spoken about the transmission, the CP rates and the CD rates, if you look at them, the money market rates are much lower than what the rates the bank has announced. So what SBI has announced, what other banks have announced, these are very high rates compared to the money market rates. And if somebody has the capability to go and tap the money market, they will get much lower rates. So they are not anyways going to come to these banks for loans. Over a period of time, if these rates come in line and the transmission is much more sharper, I think this will help in these banks' credit offtake. And as rightly put, I think that once the liquidity deficit comes down, which has to be due to various sources of liquidity. And currently, if you look at it, I couldn't get a chance to comment on that, but Governor mentioned clearly around the election time, the liquidity, the cash leakage is there, cash in circulation goes high. And it's difficult to assess how much it is. So it's, as per them, it is about 40 to 50,000 crores, which is the amount of liquidity deficit which is there. And if you look at the sources of liquidity, all sources of liquidity, barring that in the recent month, March, we got about 4 billion of flows on the equity side. But if you put it in perspective in the entire fiscal year, we have got about a flat fixed income book flows on the FPI side, and we have got about 1.5 billion negative flows on the equity side. So, which compares to about close to about 38 billion dollars on the year before that. So clearly, liquidity sources are drying up, and with also the government under pressure to meet the fiscal deficit target, their cash balances shot up, and going forward now we will see that cash balances unwinding in the coming months, and again we could see the same kind of behavior from the government if they want to stick to 3.5% of fiscal deficit target. I mean, overall put together, the supply of securities is there. I was expecting a CRR because of the fact that we had gotten earlier guidance from RBI in terms of the fact that they don't want to distort the market yields. And now we are seeing clearly the supply demand is being met by RBI stepping in and buying government bonds. So clearly the route of FPI is closed because that induces volatility, and that volatility will have to be managed by RBI in the forex market. They have too much on their plate. FCNR deposits are maturing, which we'll also see about 2 lakh odd crores of deposit being shaved off at that point in time, because it's all leverage money. Some 15% is what typically will remain most likely, and we'll see this money moving out. I expect it to be managed well, because there could be a time when RBI could come in and open a special window for meeting out these redemptions. But I think forex reserves basis we are okay, but volatility, sure, it will be there.
Mr. Chaudhary, your perspective, sir. You heard the governor, the SBI CFO. Also, you were at the helm when this entire FCNR business was going on, right? Yeah. You have a...
First, the FCNR business, I think it is nothing short of a scandal. The government should not, or the country should not have paid interest rates like 5 or 6% for this, even if you look at the markets today. Now, the question is how to replenish $20 billion of assets. Now, even if you look at the markets today, the 5-year treasury is running at 1.5, and I think the government can effortlessly borrow $20 to $25 billion at 2% above the US Treasury. So that would come to 3.5%. And in the context of this kind of supply and price, to pay rates like 5.5%, 6% to select depositors, and when it is openly acknowledged that these are mostly leveraged positions, is nothing short of a scandal. And it becomes more so because the government and the RBI come together to subsidize these payments. I think this is the most retrograde form of transfer of wealth from the poor to the rich. It should have never happened.
But this happened not now, right? This happened in middle of 2013.
Absolutely, and this has created a moral hazard. Now, having done so, you create an urgency. Oh, this money is going out, so I have to do it again. Absolutely not required. The government can do a bond.
The governor clarified that. He said that we are not going to offer these kind of rates again.
Because
we're not going to do this kind of.
The way he presents the statistics is very clever. It's not very clear. Because he says that 150 basis point tightening or the lowering of the repo rate since April. But why is April taken as the starting point? Why don't you take July 2013 as the starting point when the governor assumed office? Since then, the reduction in the repo rate has been just about 75 basis points. So the reduction in the base rate also mirrors that. Now, he is totally ignoring the fact that when the repo rates were increased by about 75 basis points between July 13 and April 14, the banks never increased their base rates. I think the base rate does not at all respond to the cuts or the levels of the repo rate. They are more a function of liquidity. And if you track the movement of the base rates when CRR was reduced by 1%, you will find a much sharper drop. And similarly, when CRR was raised by 1%, the rates went up much more sharply. So the rates are a function more of CRR than of the reverse repo. I think we are, knocking at the wrong counter. Secondly, the issue of tight liquidity, I think investors and depositors have rightly punished the banks for offering very low rates even compared to the post office savings rate. And this was something that had to happen, and I hope this message has been received by banks. And particularly for SBI, which was very aggressive in cutting the deposit rates, I think the liquidity shortage would be pretty severe, and the depositors have also said and given a message that enough is enough, just don't take us for granted. If you drop rates like this, then possibly we are not coming to you. It is for the banks to take that call. And for the first time in last 3 or 4 years, I think SBI has turned to what is called the bulk deposit market. And the reduction in the shortage of the liquidity has been accentuated by many other things. Though we are celebrating that the fiscal deposit target has been met, large amount of fertilizer subsidy has not been disbursed. So if this amount, because saying that there is a budgetary constraint of 75,000 crores, I can't disburse more than that. So fertilizer companies have not received the fertilizer payment. That's why they're drawing for the subsidy payment. That's why they're drawing from the banking system continues to be high. And the year-end disbursals of money that used to happen earlier, I think also has not happened. So all in all, the liquidity situation continues to be grim, and in this situation, trying to bring down artificially or by coercion the lending rates would not work. And I think stock markets, which are almost a predictor of the future events, a collective opinion of the future events, have assessed the situation very correctly, and both Nifty and Sensex are down by more than 1%, about 1.3% presently.
Okay, that's a very rounded up view. Mr. Chaudhary, just coming back to all of you, Mr. K.K. Mistry, Vice Chairman and CEO at HDFC Limited, is also joining us on a phone line. Mr. Mistry, thanks for holding the line. Prashant here. What should we expect in terms of rates in the economy, sir? Borrowing rates, borrowing costs in the economy after this policy?
See, my sense is that the external environment is very conducive, is very benign compared to what we've been used to seeing in the last couple of years. Inflation, at least the inflation numbers are lower. The targeted inflation for next year, I think, is around 5%, which is fine. Government has reduced small savings rates, so the competition for bank deposits to that extent has reduced. The government's fiscal deficit target of 3.5% is, in the sense that they've stuck to the 3.5% target. The likelihood of Fed increasing interest rates sharply, that risk has receded significantly in the last 3 or 4 months. So all in all, the external environment is very benign. And with RBI now asking banks to come out with this marginal MCLR, the marginal cost of funding, if banks are able to reduce their deposit rates, then the cost of funds of banks could come down, and that benefit would automatically pass on to consumers. But the question is, why are banks not reducing their deposit rates? And the prime reason for that has been the fact that liquidity in the system, particularly in February, March, was very tight. And therefore, it was critical that the RBI try and tackle the liquidity issue first, which is more important than just cutting rates. And therefore, it's good to see that there are measures which have been announced in the policy on how adequate liquidities will be maintained in the system. So that will give banks, that coupled with lower small savings rates, may give banks the ability to lower the deposit rates, which will then automatically result in a reduction in the marginal cost of funding, which under the formula will be passed on to customers.
So at HDFC specifically, any moves we can expect on rates?
See, we have ultimately our lending rates are driven by our cost of funds. So if cost of funds comes down, naturally the lending rate will also come down. Now, how quickly the transmission happens in terms of cost of funding coming down for us is something we have to, wait and see. We have to see some stability in funding rates. We have to see some stability in liquidity, and that's the time we will look at lending rates.
So just one question, since I've got you on the phone line, away from interest rates, this is HDFC specific. There was some concern that HDFC Bank had been, now this is not new, but had been buying back a lot more of the mortgage loans that it was originating for HDFC, and that had affected HDFC's earnings trajectory. I just wanted your thoughts on that, sir. I mean, how are things going to look from here?
So HDFC Bank accounts for about 26% of the business we do. So they are one of the distributors of housing loans. And the arrangement that we have with them is that they have a right to buy either 55% of the loans that they source or 70% of the loans that they source. If they buy 55% of the loans, then we are required under the agreement to prop up from our own stock of priority sector loans, add another 15% priority sector loans and give to them. If they decide to buy 70% of the loans, which is what they've done last year, then we are not required to dip into our stock of priority sector loans. So when the bank buys 70% of the loans, the loan book, the on-balance sheet loan book reduced, the growth is lesser. But when we sell a loan to the bank, we get a certain spread on those loans. We do not account for that spread upfront, and we earn that income over the life of the loan. We do not upfront that income the way we would be required to do if we were adopting IFRS, or I think even under Ind AS, we may be required to upfront that income. We don't have Ind AS applicable till 2018, and therefore we will continue to account for that income over the life of the loan. Now, when we sell a loan to the bank, we don't provide any credit enhancement. There is no risk that we take in respect of those loans. There is therefore no capital that we need to provide in respect of those loans. So without providing capital, without taking any risk, we continue to get a spread of a little under 100 basis points for the life of the loan. So it results in a much sharper increase in return on equity. So now the question is whether you're looking at accounting profits or you're looking at return on equity. Most long-term institutional investors look at the return on equity, which obviously gets enhanced if you are able to earn income without deploying capital.
For 17, I mean, is there any indication? Do you agree at the beginning of the year, or it depends on what the bank wants to do in terms of how much it wants to buy?
That is something they have to decide at the beginning of the year. My sense is this year also they may want to buy 70% of the loans, but the base has already got set last year, because last year itself they bought 70%. So the base has already been cleared last year.
All right, Mr. Mistry, thank you for that explanation. Very useful. Appreciate you joining us with that perspective today. HDFC Limited at about 1102, 1103. It's absolutely flat. So 100 points clean. Mr. Chaudhary, you sort of pointed us you said look at the Nifty and the Sensex, and that is telling you the real story.
The
So you
collective wisdom
you
of
obviously
the investors.
yeah, but are you so a CRR cut was a much better thing to do. It has not happened.
Always.
And you don't
And the
expect
rest is
transmission to be extremely
The
slow,
rest
right?
is meaningless. See, this 25 basis point cut, in fact, if you look at the bank's profit and loss account, how much of the interest is attributed to the interbank or to the repo borrowing? Not even 1%. So, if that 1% is reduced, it hardly makes a dent in the bank's borrowing cost. So, therefore, there is no room for passing on any of this cost. And secondly, this 4%, sterilization doesn't help anybody. If this were not there, the banks could have been able to offer higher rates to the depositors and charge lower rate to the borrowers. So, both would have benefit, and in the absence of that, keeping these deposit rates low have driven Indian households towards, investing in things like gold, etc. Because earlier the CRR used to be 12% and the same wise RBI policy, 37% SLR and 12% CRR. So, the deposit rates used to be peanuts, and the investor, the household generally believed that no point trying the banks with that, I am better off investing in assets like gold, and later on came the real estate and all that. So, that is what has happened to the financial system. I think this financial repression, depressing the returns that you pay to the depositors, will not lead to the growth of the financial system, and let the banks be warned that if they drop the deposits rate further, I think they would increasingly face the boycott from the general investors or the general households. So, therefore, the deposit growth would continue to be slack, and the people who think that interest rates have no bearing on the savings habit need to reconsider their positions. So, banks would continue to be punished. I think they have very aggressively cut the deposit rate much beyond what was necessary. They have tested the patience of the depositors, and now no surprise that they are coming back and saying, hey, I am short on liquidity. That was bound to happen. If you treat depositors like this, then who would come and put money with you? And if you don't have depositors, you don't have liquidity. It is as simple as that.
So you're saying cutting deposit rates is not the answer. Free up the bank's balance sheet. That's basically what you're saying.
No.
To release capital.
It has to be in balance. You cut the deposit rate, take it so low down compared to the government savings rate. Why should people come here? And it is not happening in India alone. It has happened all over. Particularly, I have given the two examples of countries very different in their economic growth, Japan and Bangladesh, where the postal savings rate...
Mr. Chaudhary, what is the difference between the small savings rate and the deposit rate now?
You look at that, 5-year small saving rate is I think 7.8%, and 5-year bank deposit rate is 7%, SBI rate is 7%. Which fool would go to bank and not go to the post office?
I have not met many people who go to the post office, sir.
Yeah, you please go and visit and see the rush. In fact, if you have not gone, at least you have seen the rush at the counters of post office on 30th March.
Okay.
So, if you want to verify
enough.
that, you can visit the post office and find out.
Talking about balance. We were talking about balance. Please, can you complete that point?
Absolutely, because balance is suddenly you are required to lower the interest rates and you go and cut the deposit rates, not paying a damn that what the alternative instruments are offering. So, you think that regardless of what you pay, the depositors would be crowding at your
What is the alternative? What is the
post
alternative?
office.
No, not for investors, for the bank, for SBI, for example.
Yeah, no, SBI is not getting money. You can make finished goods only if you have raw materials. So, SBI's raw material supply has dried up for most banks. So, that is why there is a shortage of liquidity.
Yeah, no, I'm asking you, what is the alternative in the current situation?
Rates slightly make them at least comparable to the post office rates. And
then?
the lending rates also, is 8.95, what Mrs. Kant said for the CFO of SBI, is for one day borrowing. for 7-day borrowing. In fact, earlier the banks used to have a short-term PLR and a long-term PLR, because short-term money cannot be equated with long-term money. Even if you look at the government borrowing, the price of the treasury bill and 10-year bond cannot be the same. And if you look at the deposit structure, the price of a 1-month deposit, 6-month deposit is not comparable to 5 years. So where we erred was, we gave a fiat that there should be one base rate, and saying that short-term money and long-term money, the costs are the same. But what MCLR tries to do partially is to distinguish short-term money. So this will benefit the larger customers who run cash credit. In fact, what Mr. Srivastav said, maybe a residual portion, still say Indian Oils or the Reliance or NTPC or not Coal India, but Steel Authority, they run a cash credit. For them, there would be slight reduction in their cash credit cost. That too on a daily basis. You cannot predict what will happen after 1 month. But for home loan buyers or for the car loan borrowers who want money over longer term, there would be no reduction at all.
Okay, let's just get a quick last round of answers from everyone. Madan, would you continue to, what is your...
Yeah, actually, there's something not directly related to the policy, but if we are all talking in terms of banks lowering or not lowering the deposit rates, lowering or not lowering the lending rates. But if you actually look at some of the spreads of Indian banks, I think it's one of the highest in the world today. So if you actually look at RBI data, say on an average basis, what's the cost of deposits, what's the return on advances, I think the 3.5% which we earn is very high. So I think what's really happening is we have this convoluted system where I want to continue to earn these kind of spreads. So banks don't want to make a loss anywhere, and it actually serves the purpose very well, because when banks, especially public sector banks, make large amount of profits, you get a lot of dividend which goes back to the government. So it actually serves the system very well.
And private sector banks make profits, you get large bonuses.
We get large bonuses, large dividend payouts. So I think it helps everybody in the system. So I think that's something which we could actually concentrate on, because I think this is always an issue which we had, that earlier when small savings rates were high, I think on this particular discussion panel itself, we had lots of arguments saying that we should lower the small savings rates, then we lower the deposit rates, and then we suddenly realized we're in this rut where deposits are not growing and there's a liquidity problem. The second issue which I want to flag is, of course, I think I agree largely with what Mr. Chaudhary said about the FCNR deposits. I think that's going to be a major problem which you're going to have during the course of the year. Just remember, forex reserves have not really been increasing, and we won't be having a free flow of FIs coming in this year. FDI is just about going to be where it was earlier. So in this kind of a situation, I think there's going to be some kind of hit we have to take on our forex reserves, unless the government decides to borrow in the international market to pay this back. But again, some kind of evergreening which at the government level, which I don't think is likely. So I think we can expect a bit of volatility also on the exchange rate as we move towards the repayment time.
Mr. Chaudhary, just very quickly, do you agree with this point that bank NIMs, Indian bank NIMs are one of the highest in the world? I mean, I don't know.
Mr. Sabnavis to look up the data internationally. In fact, this was brought up in a meeting with Mr. Chidambaram when he was the finance minister, and it found that SBI has a net interest margin of 3.2. And when they shuffled through the data of European banks and American banks, where the absolute interest levels are much lower, there also the net interest margins are something like between 2.8 to 3.5. So what Mr. Sabnavis is saying is not borne out by facts and data.
Actually, I'm not looking at net interest margin. I'm taking, if you look at RBI data, look at the cost of deposits.
Please look at the Banker magazine.
I'm looking at that particular number.
When you're talking of global banks, I don't think RBI publishes that. Please look at the Banker magazine, which is a very authentic source of the data, and you will see that European and American banks, which are large enough and which operate in free economy, where the rate, absolute rate, the LIBOR rates are in some economies are as low as 0.1%, and US it is something like 0.6%. Even there, they have rates like 3%, the net interest margins of 3%.
Atul, you want to add something?
Just look at the Banker magazine to substantiate that.
Sure. Atul wants to add. Atul, go on.
Yeah. So I think I agree with Mr. Chaudhary. What's really happening in the advanced economies is that the credit spreads are very different for a AAA versus a non-investment grade. It could be as high as 7 to 8% differential, which is not the case in India. So if you look at the balance sheets of any of the developed market banks, you would find a substantial portion is invested in the non-investment grade or just about the investment grade kind of securities or loans, where the spreads is about 7-8%, whereas the spreads on the AAAs or the AAs is hardly about 25 to 50 basis points. So as a combination of these two, their NIMs are actually very high. The spreads are at about 3%, which is not very different than where the Indian markets are. Because Indian markets, we don't have that kind of distinction between a AAA and a BBB or a AAA and a BB. So I think that's the underlying fact which is substantiated by numbers, by what Mr. Chaudhary said.
Okay, fair enough. Mr. Chaudhary, just to go back to the point about FCNR, you think you were suggesting that the government will be able to deal with it in an orderly manner, or you were saying that they should have used a different source of funding back when they raised these deposits?
Just do a sovereign bond issue. Don't pay heed to this kind of scare. Just pay to the sovereign bond issue. And even what to talk of government, SBI or even IDBI or even HDFC Bank, if they were to do a medium-term note 5-year borrowing, they would get this kind of pricing. But Indian banks do not do a sovereign issuance for deploying in the Indian markets. But if the government were to do, which is a very common practice even among countries like Philippines, Indonesia, Turkey, Korea, Mexico, the borrowing costs, and in fact, when the foreign banks come and visit us, they say, who pays this kind of interest? Even the most desperate countries would never pay this kind of interest. Again, I maintain that this is the most retrograde form of transfer of wealth from poor countries to the rich countries and should be stopped forthwith.
I think the governor said not happening again. Mr. Srivastava, you want to add anything to the discussion before I wrap up? Closing comments, sir?
I think what we need to just look at now is obviously RBI is focused on inflation, and going forward still RBI maintains an accommodative stance. So if there is a space going forward, we can expect maybe a 25 or a 50 basis point more rate cuts in the coming fiscal. But it is entirely dependent on how the inflation pans out. And we have to look at the other sources of volatility, maybe the global, though now the risk or the probability from the global end looks very low, particularly with Janet Yellen coming out with in most concise and clear communique that they're going to look at the global risk. So we are looking at a different kind of buffer, they are looking at a different kind of buffer. If they raise rates too fast, then they do not have buffer to cut down. While we are looking at a place where if we cut down too fast, we do not have a buffer to raise up. So that's probably the quandary which we are in right now.
Okay. Before I wrap up, Atul, you want to make a point about the accommodative stance language which has been used in the policy. Not now, the last policy also had that.
So I guess it's not unconditional accommodative stance. I think he's made it conditional on 2 or 3 things. The first one being that there has to be a good monsoon, which should then reflect into prices of the vegetables, food remaining under control. But this is not really, I would say, unconditional as such, because irrespective of whether we had a good monsoon or not a good monsoon.
Say that I'm going to be accommodative irrespective of other variables, right?
Yes. So one is, of
You're
course,
saying there's too much focus on the accommodative stance.
Yes, it is not unconditional.
Okay.
He has made it conditional upon good monsoon, transmission. Now, transmission again, I again agree with what Mr. Chaudhary had said, that if you actually look at the GSEC market and if you take a full period of just the interest rate reduction, which is 150 basis points, the GSECs are actually reflected the entire 200 plus basis points reduction, whereas the loan market, it's not a tradable instrument. Loan is not a tradable instrument, so there would be an illiquidity premium on the instrument. So you cannot expect an illiquid instrument to reflect the full transmission as such of a liquid instrument like a repo. So these are the 2 things which we need to think about before we look at accommodative stance of RBI in an unconditional
So you're saying eventually
manner.
RBI may not turn out to be as accommodative.
Exactly. Yes, that's
where
right.
you're getting it. Fair enough. I'm out of time, gentlemen. Thank you very much, Atul. Thanks for coming in. Mr. Chaudhary, as always, it's a pleasure, sir. Madan, thank you for being with us, each policy. And Mr. Srivastava, thank you for joining us today as well. Appreciate all of you and your perspectives on the policy, on this policy. I'm going to wrap up and I'm just going to leave you with the government's point of view as well. So I'm being told that Mr. Jayant Sinha has made some comments. And we also had Mr. Shaktikanta Das, the Economic Affairs Secretary, making some comments in reaction, in response to what the RBI has done. So we're going to play those out, take a quick break and see you on the other side.
we believe that with the rate cut that has been effected is that it will be a really good stimulus for the economy. We obviously, through our own fiscal policies and the actions that we've undertaken as far as the budget and our reform initiatives are concerned, have created the space for monetary easing. And now in coordination with the RBI, we really have to amplify both the fiscal initiatives as well as the monetary initiatives that are now in the pipeline. And that really is what we are working on now, is to amplify the policy actions that we have undertaken. As we do so, we believe that we will provide the boost to the economy that it needs. We obviously have to wait and see what happens with the monsoon and with aggregate global demand. Thank you.
You see, India needs to become a low-cost economy, both in interest rates as well as in with regard to other transaction costs and with regard to the cost of doing business in India. We have already highlighted that the introduction of GST will significantly bring down the transaction costs and the cost of manufacturing. Similarly, the interest rates also, we are looking at a low interest rate regime so that there is more investment both in manufacturing, infrastructure and in other areas. As you are aware, government has already kept the fiscal deficit under control, 3.9% in 15-16 and 3.5% is the target for 16-17. Inflation is low. RBI has projected an inflation of about 5% for next year. Government has also reset the small savings rates. And so under these circumstances, the RBI's announcement of 25 basis points is therefore in line with the direction in which government would like the economy to move. And the banks have also, some of the banks have already reset their interest rates, taking into account the marginal cost of lending, the MCLR. They have taken that into account and done some amount of reduction of rates. Consequent to all these measures and consequent to the RBI's announcement today, the banks will perhaps need to do some more of transmission of the reduction in the policy rates by the RBI.